Good morning. Today is Tuesday, August 4th, 2026. I'm Joe Terril, president of Terril and Company, independent wealth managers based in St. Louis, Missouri, with $1,015 million of discretionary assets under advisement. This is another update on our thoughts on economy, interest rates, inflation, and investment markets. Joining me this morning is our summer intern, Thomas Dolan, and we're fascinated by the thoughts that young people have all the time. They are the future of the country. And Thomas's thoughts on AI and what's going on are very helpful to us. Longtime partner David Carter, Bill Newbold, and I already told you who I was, as if that's important. But I wanted to start today by just maybe having more of a roundtable discussion. We've been saying for some time interest rates are going higher, and that's happening, but they're going higher at a snail's pace. 10-year government bonds somewhere around a 465. Had been 472, but it is close to, what do you guess, it's a 4 or 5 year high on a 10-year yield on a bond?
Yeah. And it's up 0.5% since February.
Yeah, so we continue to feel that we've got to be very careful about all of our investments because so much trades off of the general level of interest rates. How the bond market, lenders all over the world are going to lend all this money that corporations want to borrow in order to do AI spending, the amount of money that governments all over the world want to borrow to finance all their various programs, including here in the United States, where we're going to have to roll over about $9 trillion of debt coming due, plus borrow another $2 trillion on top of it. Our general theme of why interest rates have to move higher is predicated upon the amount of borrowing that has to be done, and investors saying, if I'm going to lend money, I want a higher interest rate. And that seems to be going on, particularly outside the United States. I'm not sure our viewers, but yields on 10-year Japanese bonds, 10-year German bonds are also making close to a high. So in our fixed income portfolios, we've stayed with very short durations. We've continued to own floating rate paper, reset paper that protects us against getting locked in with an interest rate at these levels. We don't want that. We want to be able to have higher interest as we go forward, and that's been the right strategy. People who have done the opposite and have laddered a portfolio to include long-term bonds, that's been a poor strategy. So with that said, let's just chat a little bit about, we have a new chairman of the Federal Reserve Bank. Talk about our thinking here, if we can, for a few minutes, just about why we continue to believe interest rates have to go higher.
But let me jump in here with Kevin Warsh, and he made an interesting comment.
The new chairman of the Federal Reserve, for
Yes.
those that don't know.
Yeah, and his recent conference after they held rates where they are, he made the comment that the market needs to play the ball, not the referee, referring to himself as the referee or the Fed as the referee. Basically, I think what he's saying is, I want the markets to set interest rates. I don't want the Fed to set interest rates. And within minutes after that comment, the market reacted with higher interest. The rates went up after that. And I think he wants to be sort of a hands-off type of Fed and not intervene with the market.
Well, the only thing that I would argue there is the Fed, until he's taken over, and I don't know what he's going to do, in my opinion, still guilty of quantitative easing. They had this Treasury bill program of buying Treasury bills, and they said, well, that was because we have to have liquidity and blah, blah, blah. I don't care what you call it. You're printing money. You print money, inflation's going to stay, which it is. It's stuck at over 3%. And all the comments by people about, well, and he's pounding the table telling everybody I'm going to get it back down to 2%. If he's going to get it to 2%, I don't think just a hands-off approach is going to work at that. He's going to have to stop the quantitative easing and stop printing money.
Well, they're printing money because of the fiscal side.
I
so-
why they're doing it, we can
So-
debate all that later,
Right.
but they're definitely still printing some money, and inflation's definitely
So I think his
stuck
thesis,
north of 3%.
I think his thesis is, I'm gonna let the market raise rates so I don't have to. And if the market raises rates, that will tighten money.
Well,
I don't know if that's
Yeah,
right or wrong.
I think they've also floated the notion of less Fed meetings,
Yeah,
right?
Yeah.
And so relative to other Fed chairs, Kevin Warsh may be a bit less communicative relative to other Fed chairs. As David mentioned, his kind of thesis is let the market take care of it, and the market did take care of it, so that kind of gave them a free pass as to raising rates, right? Because the market did it itself, so it accomplishes the same thing, but quicker. So,
Well, in what time we have here left, we regularly do at our investment meetings talk for hours, but our producer here, Brian, said he's going to let us do that. Let's switch and start talking about stocks, because at some point, if we're right, higher interest rates have to affect stocks. But at the moment, it doesn't seem to make a difference about all the troubles in the Middle East. It doesn't seem to make a difference about what's going on with deficit spending. All anybody wants to talk about is artificial intelligence, AI, and it's going to grow to the moon. Everybody's going to spend billions. It's going to make the economy boom forever, and therefore forget all these other issues. Stocks must be a great buy, and it's going to keep the economy strong. I'm going to put you, Thomas, first on the spot here a little bit. You believe that?
Yeah, I would say that is kind of true, but I think it remains resilient throughout. No matter what happens with, like you said, rates or the Middle East. It seems to be completely resilient. And
What I meant is, do you believe that all of the companies that are spending literally billions, put it all together, it's $1 trillion being spent on getting ready? If I'm a hyperscaler, I'm going to sell AI to all these customers. They're going to spend billions back with me. There are a lot of high-tech, intelligent people out there that say they're grossly overestimating this. That's what I'm asking. I'm going to put you on the spot.
yeah,
Are these corporations too optimistic that are spending all this money on AI? It's good for the economy, no doubt, but
yeah,
are they, or are they, nope, they've got it figured right, and that's the right amount of money to spend?
I can't say they're exactly right or exactly wrong, but I think it's a little bit of like game theory or like prisoner's dilemma, because if one company spends billions and billions and billions and it ends up being correct, then everyone who didn't is, permanently stuck below them, especially if they don't own the capex that you had to shell the hundreds of billions about. So I think, after like the first mover, everyone else had to follow, because if you don't follow and it turns out to be right, then your company, probably won't exist in 50 years.
Well, our equities are doing really well while we stay away from that high risk. Dave and I, we were talking this morning about a company we follow, and the fact that when people became a little bit worried about this, the stock was down 50% and nothing flat. Now it's back up 25%. That kind of volatility trying to be invested in these stocks, we don't need it. We have another nice quarter going with the stocks that we own. And I think there's some trickle down to this. Verizon, as an example, going, well, that's a cell phone stock. But Verizon also owns fiber optic cable, and they recently said, we're being approached by these companies about carrying a lot of their data from data center to data center on our fiber optic cable. Google's interested in spending $1 billion with us to do that. They're going to be a beneficiary if this AI comes through, and you don't have the risk that you do in these other companies. We know about the energy stocks. This morning, Energy Transfer reported earnings, and all they can talk about is how many contracts they're signing for natural gas by these hyperscalers that want the natural gas for data centers. So, Bill, in particular, talk a little bit about what you think of this situation.
Yeah.
I think you can make plenty of money
Sure.
without having the risk of stocks that may or may not fall 50%.
Right.
You may pick a big winner, you may pick a big loser.
Right.
Why even worry about that? We see the volatility in the market.
Sure. Volatility is unprecedented. When you look at what happened over in Korea with semiconductor stocks, how it bled here. And so I think what Joe is alluding to is there's a little bit of a delicate balance going on in the market right now. So you've got this incredible AI capex that's being spent by the hyperscalers that's going to be over $1 trillion next year. And there's some questions about, what are the returns on that capex? But you can also do very well in what we call AI adjacent themes, right? So recently 3M reported, as a name we own, had very good earnings. They talked about how AI is improving their efficiency, product innovation, and time to market. Joe mentioned Verizon with the Google fiber optic, plan. We're also seeing the banks benefit from AI adjacent themes. So the banks are doing very well. So what we try to do is stay disciplined and find companies that can benefit from AI, but not be the driver of CapEx spending.
What I really also want to add to this about volatility and what's a good investment and what's not right now. Bill, talk a little bit about the hedge fund run by the young man who tremendous AI talent but doesn't understand how Wall Street works, and basically how the hedge fund had to go broke and what that did to AI stocks. Tell people the
Sure.
story.
So there's a AI hedge fund known as situational awareness, and it got a lot of notoriety because of the young founder who was 24 years old, an AI executive himself, and he starts this hedge fund, and he's able to build it from 200 million to 20 billion to ultimately 40 billion. Right, and the banks are giving him loans to do this, so he's leveraging up his positions. They're very concentrated, but he doesn't understand the mechanics of margin calls when stocks start going down. So in essence, what happened is this young man gets his fund up to 40 billion. We start to see some volatility in the chip and semiconductor sector. He starts getting margin calls from the banks. And in 2 to 3 weeks' time, a $40 billion fund goes to 10, and Citadel ends up buying out the fund to take the risk out of the market, and now this young man has gone away. And so just go show you how quickly volatility can impact the markets. Dave, I don't know if you want to add to that.
But I mean, you had some severe sell-offs with the chip companies and the power companies that were all related to the AI trade, to the tune of 50%. And so it wasn't just situational awareness that was being, impacted by this. Cotu, another hedge
Right.
fund, was down 10% in a month for like the first time ever.
Ever,
You know,
right.
It's a very highly respected hedge fund.
Sure.
But he wasn't as levered to the
Mhm.
trade, so.
Well, in what time we have left here, what of the non-AI stocks do we believe still offers good value, or as we like to tell people, we think there's 3 times the upside for what the potential downside may be? Talk about a few names, will you please?
Yeah, we touched on, the energy, infrastructure companies, Energy Transfer and the MLP space. Those still look like they provide a lot of value. They have growth, and the growth is, is measured. It's not a free-for-all. It's measured with contracts behind it by users, not by blue sky pipelines. We like that sector.
As maybe our viewers don't realize, we like to find companies that we think has a lot of cash flow that also potentially can be an acquisition target. And that's worked out really well for us over the last 4 or 5 years, finding these companies.
Mhm.
I personally think, and you guys chime in, that that's going to continue. I mean, we're even now seeing the potential that Bristol Myers and AstraZeneca in a $400 billion potential merger.
Mhm.
There's nothing now that prevents people from saying, I want to buy cash flow, or I want to buy some potential growth, or I want to buy assets. That is going to prevent that from happening. I think if you find the right companies, that's a maybe bonus you might get.
It is a stock picker's market now. There's no question about that. And you're seeing a bifurcation between the companies that are executing and performing well and the ones that are not. And you are.
Well, I'm going to throw out the name Disney, which is one of our holdings that we continue to buy, continue to be very confident about. It's not so much maybe as a merger, as it's also the potential. They own so many cash flowing assets, whether it's the cruise ships they have now, whether it's the theme parks, whether it's the movie studios, the film library. Companies also are beginning to realize, hey, we can split this entire company up and do much better. And I don't know, I think a company like Disney owning ABC News, ESPN, the assets there are just unlimited. I think there's more companies that can do that type of thing, and I'll be surprised if Disney doesn't do that sometime in the near future.
Well, you are seeing more spin-offs and more corporate restructurings, and investors are focused on, are like focused companies, and they will value a focused company more than a conglomerate in today's world, because they'll value the growth company as a growth vehicle, and then the cash flow portion they'll value a little differently. But net, the total value will be higher.
Well, we'll see. We thank you for tuning in for an update. We've gone longer than we normally do, but we'll try and be back in a couple of weeks. We're in the middle of corporate earnings season right now. We have at least 4 or 5 companies that we own that report this week. So we'll have a lot better idea of what companies are thinking, and we'll be back in a couple of weeks with an update. Thanks for tuning in.